Have you ever noticed that two traders can take the exact same setup, using the exact same smart money strategy, yet one gets stopped out while the other catches the entire move? So what's the difference? It is usually not the order block. It is not the liquidity sweep either. The missing piece is confirmation. And one of the simplest ways to find that confirmation is by reading volume correctly. It is an indicator almost every trader has on their chart, but very few know how to use it properly. In this lesson, I'm going to show you how to combine volume divergence with smart money concepts to identify higher probability trade entries. We'll look at why volume reveals what's happening behind price, where most traders misuse it, and then walk through real chart examples so you can see exactly how these confirmations come together before a trade is taken. But before we look at the charts, there's something important you need to understand. Most traders use volume the wrong way. They expect it to generate a buy and sell signals. That's not its job. Volume isn't designed to tell you when to enter a trade. Instead, it tells you whether the current move still has conviction behind it. It is another layer of confirmation. Smart money concepts tell us where we're interested in trading. Volume helps us decide whether the reaction we're seeing is actually worth trusting. Today, we're focusing on volume divergence, because it's one of the simplest techniques to understand, yet one of the most effective when combined with proper market structure. Once you add volume indicator to your chart, you'll see a series of green and red bars appear beneath price. At first glance, it doesn't look like much, but don't let its simplicity fool you. Those bars are telling a story that price alone can't always reveal. Here's the important part. The indicator isn't measuring momentum, it is measuring participation. Every bar represents the amount of buying and selling activity that took place during that candle. When volume increases, it tells us more traders are getting involved in the move. When volume starts decreasing while price continues moving, it tells us that move is beginning to lose strength. And that's exactly where things get interesting, because sometimes the chart appears perfectly healthy. Price keeps making higher highs. Everything looks bullish. Most traders continue buying without hesitation. But underneath the chart, a completely different story is beginning to unfold. That's the first clue that the market may be preparing for something most traders haven't noticed yet. And that's exactly what we'll uncover next. Take a closer look at what's happening now. Price continues climbing. Every new candle looks bullish. If you are watching price alone, you probably assume buyers are still firmly in control. But now shift your attention below the chart. Notice anything different? While price keeps pushing higher and the volume bars are gradually getting smaller. That difference is the first warning that something beneath the surface is changing. Buyers are still managing to push price higher, but they're doing it with less participation than before. And that's what we call volume divergence. It happens when price and volume stop telling the same story. Price continues moving in one direction, but the participation behind that move begins fading. On its own, that doesn't mean price is about to reverse. That's a mistake many traders make. They spot divergence and immediately jump into a trade. But divergence isn't an entry signal. It's an early warning that momentum is weakening. The actual trade still depends on smart money confirmation. The same principle works in reverse. Imagine prices falling aggressively. Lower lows continue forming, so most traders assume sellers remain in complete control. But underneath the chart, volume begins decreasing. Each new bearish candle attracts fewer sellers than the previous one. Price is still moving lower, but selling pressure is quietly fading. Again, that's not your signal to buy. It's simply telling you that the current move may be running out of strength. So the question becomes, how do we turn that warning into an actual trade? And this is where smart money concepts and volume begin working together. Let's imagine we're looking at a higher time frame chart that's clearly bearish. Price has already created several breaks of structure to the downside, leaving fresh, unmitigated supply zones behind. Our higher time frame bias is already established. We're only interested in selling. Now price starts retracing. Instead of chasing it, we patiently wait for it to reach one of those higher time frame points of interest. Once price arrives, our focus changes. We're no longer asking where the market is going. We're asking whether buyers still have enough strength to continue pushing higher. Watch the candles carefully. Instead of exploding upward with strong momentum, price begins slowing down. The impulsive moves become smaller. Momentum starts fading. Sometimes price even drifts into a period of consolidation or distribution inside the point of interest. Now look back at the volume indicator. If price continues pushing higher while volume keeps getting smaller, that's our first sign the rally is running out of strength. But here's the problem. We're still not entering. Not yet. Because weakening buyers don't automatically mean sellers have taken control. That's the missing piece. What we're really waiting for is proof that smart money has actually stepped into the market. That proof usually arrives as a change of character on the lower time frame. And if that change of character is accompanied by a noticeable increase in bearish volume, something powerful happens. The higher time frame structure, the point of interest, the volume divergence, and the market structure shift all begin pointing in the same direction. That's when a setup starts moving from possible to high probability. Now let's leave the theory behind and see exactly how this process unfolds on a live chart, where every one of these confirmations appears step by step before the trade is ever placed. We're looking at the British pound against the US dollar on the 1-hour chart, and before thinking about an entry, we always begin with the bigger picture. Notice the overall market structure. Price has already produced multiple breaks of structure to the downside, confirming that sellers remain in control. Along the way, each bearish impulse leaves behind fresh, unmitigated supply zones, so our higher time frame bias is straightforward. We're only interested in looking for selling opportunities. Now watch what happens as price begins retracing. Instead of chasing the move, we simply allow price to work its way back toward the most recent unmitigated supply zone. Eventually, it gets there. At first, everything appears to be unfolding exactly as expected. Price taps the supply zone, briefly trades above it, then quickly closes back below with a strong bearish engulfing candle. For many traders, that's enough. They see the engulfing candle, and they immediately enter short positions, placing their stop losses just above the order block. But here's where the chart tells a different story. Instead of continuing lower, price turns around and pushes higher again. Every one of those early sellers now becomes liquidity. Their stop losses are sitting above the supply zone, and the market moves directly toward them. This wasn't a failed setup. It was inducement. The market encouraged traders to sell too early before collecting the liquidity resting above their stops. Now notice what happens next. After taking that first pool of liquidity, price doesn't reverse immediately. Instead, it continues climbing toward the next unmitigated fair value gap. Once again, traders expect this fresh level to hold. After all, the overall trend is still bearish. But smart money isn't finished yet. Price pushes through the second zone as well, triggering another round of stop losses from traders who entered prematurely. Then something important happens. The market finally reached the true point of interest. Now pause the chart. Look at everything that's already been accomplished. The buy-side liquidity above the supply zones has been collected. The fair value gap has been mitigated. The market has removed the obvious reasons to continue moving higher. So where is the price likely to go next? The next logical objective becomes the sell-side liquidity resting beneath the previous lows. This is exactly the kind of higher time frame confluence we're looking for. But here's the mistake that catches most traders. Even with all of this evidence, I still wouldn't enter the trade. Why? Because we've confirmed where we want to trade. We still haven't confirmed when. To answer that question, we need to zoom into the 15-minute time frame and let the lower time frame price action tell us whether sellers are actually stepping back into the market. And that's where volume starts revealing something that price alone doesn't show. Now we're looking at the same setup on the 15-minute chart, and this is where the real confirmation begins to appear. As price continues pushing into the higher time frame point of interest, it still looks bullish. Higher highs are forming. The candles remain strong. If you were only watching price, you'd probably assume the rally still has room to continue. But look underneath the chart. Something no longer matches. While price keeps climbing, the volume bars begin getting smaller. Buying participation is fading. That's our first warning. This is bearish volume divergence. It doesn't tell us to sell. It tells us to pay attention. So instead of entering immediately, we let the market continue developing, and then it happens. Price finally loses momentum and closes below the most recent swing structure on the 15-minute chart, giving us a clear change of character. Now compare that move with the volume indicator. Earlier, volume was gradually shrinking as prices pushed higher. The moment market structure shifts, a noticeable spike appears in volume. That's exactly what we wanted to see. The divergence warned us that buyers were becoming weaker. The volume spike confirms that sellers are now entering with conviction. At this point, multiple pieces of evidence are telling the same story. The higher time frame trend remains bearish. The market has already swept the buy-side liquidity. The fair value gap has been mitigated. Volume divergence revealed weakening buying pressure, and the change of character confirmed that sellers have taken control. Now we finally have permission to build the trade. The order block created by the change of character becomes our entry zone. Rather than selling at market, we place a sell limit order just below that order block. Our stop loss sits a few pips above the zone, where the bearish idea would be invalidated if price trades back through it. For the target, we simply follow the same smart money logic that brought us into the trade. With the buy-side liquidity already collected, The next logical destination is the sell-side liquidity resting beneath the previous swing low. As the chart plays forward, price retraces into the order block, activates the sell limit order, and then resumes its move lower. The trade reaches its target exactly as anticipated. Now compare this process with how many traders normally approach the market. Most traders see an order block and enter. This strategy waits. It asks whether the market has collected liquidity. It looks for volume divergence to reveal weakening participation. Then it waits for a change of character before committing to the trade. That's the difference. Volume isn't replacing smart money concepts. It's strengthening them. When market structure, liquidity, and volume all point in the same direction, you're no longer relying on a single signal. You're trading a setup built on confluence. And that's exactly what gives these entries a much higher probability. In this lesson, we focused on using volume divergence as an additional layer of confirmation alongside smart money concepts. In the next episode, we'll build on this foundation by exploring 2 more volume-based confirmation techniques that can help you filter out even more low-quality setups and improve your decision-making even further.